Everyone's asking the same question. Is the Fed really about to cut interest rates? If they do, the decision will ripple across stocks, crypto, and real estate markets. Beyond that, it'll directly impact inflation, bonds, and overall market volatility. Is the Fed cutting rates soon? And what will these new signals mean for your investments? Welcome to Money Mastery, your step-by-step guide to financial freedom and wealth creation. Today, we're connecting the Fed's latest signals to what they mean for markets through 2026. We'll move from rate cut speculation through market analysis and into actionable investment strategy. Right now, every major financial market is hypersensitive to one thing: Federal Reserve rate expectations. When the Fed shifts its stance, bonds react, stocks move, crypto swings, and the entire market follows. Traders watch first, then investors adjust. Economists analyze, Congress responds, and the media amplifies it all. The question dominating every conversation is simple: are rate cuts coming soon or not? To answer that, we need to look at what the Federal Reserve is actually saying right now. The Fed is closely monitoring three key data streams: inflation, labor markets, and overall economic growth. Recent speeches show a softer tone, but they're not committing to cuts just yet. They're signaling caution, while keeping the door open for future cuts if conditions warrant. The first major signal to watch is the yield curve, the most scrutinized indicator in finance. The relationship between 10-year and 2-year Treasury yields reveals what markets expect next. Yield curve behavior splits into two critical patterns: inversion and steepening. When the curve inverts, it historically forecasts recessions ahead. When it steepens, markets begin pricing in future rate cuts. If long-term yields rise faster than short-term yields, markets begin to expect rate cuts. The second signal comes from credit markets, specifically spreads and bank lending conditions. Lending compression and rising credit spreads both signal growing economic stress. When credit markets tighten, economic stress builds, and pressure mounts on the Fed to cut. A tightening credit market is one of the most reliable leading signals of potential rate cuts. The third signal comes from real economy data, actual performance metrics that drive Fed decisions. The ideal conditions for rate relief combine slowing inflation with softening job markets. When consumer demand slows, corporate earnings cool, and the Fed often steps in with cuts. Crypto markets can also provide early signals of changing risk appetite around rate expectations. Bitcoin and altcoin volatility often reflect broader shifts in market sentiment. When crypto responds positively to rate speculation, that's a market sentiment signal. Traditionally, rate cuts trigger several predictable market responses. Cuts typically lead to rising equities, increased risk appetite, lower bond yields, and higher borrowing. But here's the reality check that professional investors understand. Rate cuts don't guarantee instant booms. Markets often price cuts in early. Cuts can be shallow, and bonds may benefit more than stocks initially. Smart investors treat cuts as context, not a trigger. So what should you actually watch to stay ahead? Track 5 key signals: yield curve direction, credit spreads, inflation data, and labor strength. When at least 3 of these signals align, you've got a higher confidence setup. When at least 3 of these confirm, you have a higher confidence setup. Now I want to hear from you. Do you think rate cuts are coming soon? Drop a comment with your answer: yes, no, or not sure. Here's the core principle that separates smart investors from reactive traders. Markets don't move because the Fed says something. They move because prices react to expectations. Rate cuts matter, but only if you can read the signals correctly. Rate cuts are important, but only when you know how to read the signals. If you enjoyed this breakdown, hit like and subscribe. Next time we'll build something you can actually use. We're creating a Fed signals tracker to help you monitor interest rate cues every month. The tracker connects directly to rate cues, giving you a simple way to watch for changes. Thank you for watching. Meet you in the next video.